Hi, hello, welcome friends. In this video, I am going to discuss about a derivative market in IB classes. So, welcome to investment banking classes. So, first, what is there in derivatives and derivative means what and derivative purposes is why the derivative concept will be come into the picture in the investment banking. This all will concept will be discussed in this class. Now, first of all, derivative means derivative is a contract or derivative is a security that value will be derived from the underlying assets. Here, what is meant by that underlying asset? Underlying assets can be shares or bonds or goals, etc. They are mainly these derivatives are mainly used for hedging purpose. For example, if you are in a business of exporting coal business and you will purchase that coal at below price, that is purchasing price, and you will sell at a higher price, the difference will be the profit for you. For example, if you are buying in December 23, and for example, if you buy the 1 ton of coal at 50 lakhs and sell at 60 lakhs, that 10 rupees is the gain. This is normal business who we are you doing in the market. And whereas, however, if you buy this in December and sell at February or March, you want to sell at February or March, and at that point of time, if your mind tell that the price will be going down, you don't want to get that loss. So now you will enter into the contract to avoid the loss. So you can enter into a derivative contract to avoid this loss and fix that sale price at whatever you want, and so you need not worry about market risk and risk due to change in market prices. So if you enter into the contract as of today itself, and then the price will be known prices at after 2 months or 3 months or after 4 months, whatever the contract period you are entering that main cases. And for example, if you are hedging fund manager, if you are hedge fund manager, you invested some amount 100 crores in Reliance company, and you have risk of stock price fall. So stock price fall will risk will be there for any cases. If the stock is purchased at 2000 rupees per share, and if the price falls 1000 rupees, the 50% loss is there. So to avoid this loss, you can enter the derivative contract like forward contract to fix the sale prices at 2500 or 2300 or whatever the amount of base cost plus some amount will be added, and so the sale price and your profit is fixed, no risk with the market. This is derivative concept will be there. And popularly derivative contracts are that forwards, features, options, swaps, and few other contracts was swaption, TRS, and CDS, etc. And why this reason for derivatives are reason to use these derivatives similar, how each type of derivative contract will have different features. So different is there now, different features will be there, and different reasons will be there to establish their popular in these derivatives. So here, what is the hedging means? Hedging means to reduce the risk, first of all, and where the speculation means to make profit by predicting the market price of assets or securities, and arbitrage means gain by using price difference of assets in two different markets. So hedging means reducing the risk. Speculation means making profit by predicting the market price of assets or securities. Whereas arbitrage means make gain by using price difference of assets in two different markets. Whereas all these derivatives in the market can be grouped into below category. One is OTC contracts and another one is exchange traded contracts. Exchange traded contract means this contracts traded through stock exchange. OTC means that is over the counter contact, and contacts like forwards, swaps, swapations, CDS, etc. are not available in the exchanges like NSE, BSE or New York Stock Exchange, etc. So if you want to go with the forward, or if you want to go with the swaps, if you want to go with the swaptions, or if you want to go with the CDS, then you need to go with the OTC only, that is over the counter contract. It is not allowed in NSE or BSE or New York Stock Exchanges. So they are over the counter contracts. This can be used by any person or anywhere. Contract like features and options are available in the stock exchange in BSE or NSE. So commodities exchange like MCX and NCDX, etc. So any business house or company like this, telephone, TCS, Infosys, any investors or traders, any professional dealing with commodities, etc. Then they can use this OTC contract to reduce the risk. So, for example, if the TCS company is there, it is exporting one software in the market, and they may get gain or loss due to avoid any possible loss. So they can use any of these derivative contracts like forwards that is in OTC. Company need not use the stock exchange route. So OTC, for this OTC, it is not required to go with them OTC, and they will use this OTC over the counter in his company itself. So assume this company is deciding cost. It want to develop one software, and what will be the cost for that company? Cost may be that person's employees salary amount and rent amount and electricity amount and laptops depreciation, other cost will be there, and for that cost some profit will be added, and the price will be that quotation price, cost plus some profit, that is the quotation price. And is quotation price will be converted into USD price, and the in dollars. Here there may be a different scenario where you can get loss if the USA rate is down. If USA rate is fallen, then you will get the loss. To avoid that loss, the forward contract and fix the dollar price now itself in the cases. So here underlying asset will become the US dollars, and here the seller will be the Infosys company, and buyer will be the other company who is purchasing that contract. So there will be a date of contract will be today, and expiry date will be, and after 2 months or 3 months, 1 year, 6 months, whatever the time period they will expected in the contract, and price will be fixed today itself. Here if the market price, for example, if the market price on the expiry date was, so you are entered some prices, so based on cost plus profit, for example cost plus profit, it will be 100 rupees, and in the market and the expiry date 70 rupees is there. So what is the status, how the settlement is done means, here the Infosys will get at whatever the amount at the forward rate they were entered. Now for example forward rate is 80 rupees. If they entered at 80 rupees means 120 rupees na cost plus amount, and if they entered 120 rupees, example 120 rupees they are entered, and the price was in 100 rupees. So you are entered at 120 rupees, so you will get the 120 rupees only, and which means they made profit will be there, because even the market price was fallen, they are already decided in the agreement, so they will enter for that price only. And what is the profit or loss to counter party or opposite party, and that who is purchasing party, so that party again one party is lost to another party. In this case the other company who is entering into with this market, they will lose whatever the profit will get by our Infosys company. And at expiry date, if the market price is on expiry date will be there, and what is these forward contracts more in the market, so who can use this markets means that importer and exporter, import companies and export companies. Import companies will be Import companies will fund managers dealing with international securities, and export companies means investors or traders etc. for speculation or arbitrage. All market intermediaries like banks, foreign exchange dealers, etc. Yes, however, will be used this type of conduct. And what is the main risk with this forwards or OTC contract? Main risk will be counterparty risk. That means the loss making party do not have money to settle the contract, or they can dispute the settlement price. Where where if you go with the this means they will, if they do not have money now, they will dispute a settlement price. To avoid this, what can the company will do? So to avoid that, they will use in the agreement that use ISDA, that is International Swap and Derivatives Associations master agreement, which will cover more points, and so chances of dispute his will be less, and use the exchange traded derivatives like futures and options. So ISDA or exchange traded derivatives. So ISDA means that International Swap and Derivative Associations Master Agreement, and whereas exchange derivative like futures and options. So by using these two, you can avoid the making losses. Party risk, counterparty risk, you can avoid from using this two. One is ISDA and one is exchange traded derivatives like futures and option. What are the difference between OTC and exchange traded derivative? Exchange traded derivative means what we have discussed. This traded in in between the person will be that stock exchange will be existed. Over the counter means no middle person will be there, only the company and the other party who are entering into the contract. And terms here will be in OTC, this is a tailor made, that is means customized terms will be existed in the contract. And whereas exchange traded derivative, it is a standard contract. And counterparty risk will be there in the OTC over the counter. So here they do not have the middle person, the exchange person is not there, though the regulatory is not there. So there may be chances for getting the party amount not giving in the OTC cases. Whereas exchange traded derivative, there must be a regulated person, that SEBI will be existed. So here very few, very less chances to avoid the counterparty risk. And there, what are the example for OTC? OTC will have forwards, swaps, swaptions, etc. And whereas exchange traded derivatives, it will be futures and options, etc. And is there any intermediary? Means in the OTC there is no intermediary. In the exchange traded derivative, there is stock exchange will be there has in intermediary. That intermediary will decide the cases. Now, for example, if futures means underlying assets, what is there? If you have already have the stock, what will be the risk for you? If the price is decreasing, you will make the loss. So, if you want to avoid this loss, fix the sale price today itself. So there is no problem in the futures. So up to that OTC and exchange traded completed. Now we are discussing about futures and forwards. So in futures, if you have a stock already existing stock, so in the past we are discussing about you are going to enter into the contract. Now if you have already existing the there, if you are already existing the stock, so what is the risk? Means the price decreases, so you will get the loss. So to avoid that loss, you need to fix the sale price today itself. There is no problem in the future. If price decreases, so can we use this feature? Yes, we can fix the price at whatever the price we want. And here if you want to go these contracts like forwards, there the sell or buy price should be based on the contract data. Today, these future contracts are trading at whatever the amount. We can use any of these contract at those prices. So easily easily entering in the future contract, and whereas forward contract it is not possible to enter in forward contract. They will be based on the contract date only. So when the contract entering some price, you need to settle that price only. In future contract there is option to change the price in futures, and where the things are expecting price will go down, you can sell today. For example, if you have a sell price, whatever the amount and which contract you are buying, based on this will be there, and who is the buyer and who is the counterparty will be the main important. And is there any payment means, yes, both party need to pay to exchange that generally 20% margin. That 20% margin means initial margin the exchange traded, that stock exchange will collect before the settlement only. When the contract is entering, this will collect only 20% margin. And here there will be a large size. Large size means that standardized quantity need to purchase it, and contract price will be there and margin will be there. And that margin amount, for example, if you have a contract where price will be 1 lakh and margin will be 20%, 1 lakh into 20%, it will become, I think, 20,000 will be the margin amount you need to pay at the time of entering itself, and no need to pay that 80,000 at that point of time. It is the benefit. You no need to pay full amount at time of entering itself. And the expiry date of the contract or market price was going down or going high, then what is the gain or loss will be there. So share price will be there if it get any gain. So if one company it get the gain and another company it will be loss, so for that gain and multiplied with the loss size, and you will get the full amount, and off from that full amount whatever the investment is there deducted from the investment, after that you will get the net gain. From that next gain you will get that amount, and who is losing now from that person, the stock exchange will collect that full amount whatever price will be there in that cases. And here can this close before the expiry, so you are entered for March future. Now you in December you are entering for March. If you want to change any terms, or if you want to close before itself, and means February itself you want to close, can we close? Yes, you can close the exchange traded derivatives. Liquidity will be there, we can sell at any time, assuming the price will be there and afternoon or whatever the prices will be there. So we will see that sale price what is there and buy price what is there. Based on that we can enter into that cases, and if there is a profit, we will get that profit also. When here it will be cases, so you are closing before itself now, and you are not close the contract till expiry, what will become on that day. So for example, I think say if settle at before itself there is a profit or loss, the exchange traded will be said, if you are not close the contract till expiry, on the day market price will be decided, and the sale price and buy price what is there in buy price or sale price, and who will get the profit. So there will be more buyers and more sellers in the exchange, so they do not know the counterparty to the contract, so both the parties assume the transaction is made with stock exchange. So here there will be one middle person, and we are trading with stock exchange. So always there is, if you go to the market you will get the buyer and you will get the seller physically you can see, but whereas stock exchange we will place the order in the app, and the other person also place the order in app, and by using one stock exchange app, and we do not have the direct interaction with the buyer and seller. So we will assume that we are trading with stock exchange, and other person also assume that he is trading with stock exchange. So transactions is made with stock exchange. So stock exchange will settle the gain or loss to each party based on the difference between the buy price and sell price. For example, whatever the profit will be their bought price and sell price, and it will profit will be settled by the exchange trader, that is stock exchange itself. If margin amount, that margin amount is there 20% na, and remaining 80%, how can we collect that company that stock exchange? Here what the concept will be, if you have purchased the features, if you have purchased the features at 100 rupees per share, and that share price falls more than 20%, or the price is collected for 1 lakh, they have collected 20,000. So if the amount was the price will fall with 60,000. 60,000 means you need to pay the 40,000. You have paid only 20,000, and the stock exchange now will collect that remaining 20,000. For example, if you buy the company stock price at some amount, and margin will be paid and that amount, and you need to pay the different amount. So because the margin is not sufficient to cover the loss, that 40 rupees will be the full loss, and you have paid only 20 rupees, and you need to pay that remaining 20 rupees. So the stock exchange collect additional margins called mark to market, MTM market. So stock exchange will collect additional margin will be marked to market, margin from participants. So example, if you have deposit that 20 rupees margin today, and stock exchange decided margin will be changed to 25% or 30% tomorrow, since volatility of the more volatility will be more, they have to deposit the additional amount, that 5 rupees or 10 rupees, whatever the amount. So if you incur loss, that is daily settlement of 5 rupees today, this will be deducted from your margin. So there is shortfall, you have to pay that amount. So if you have any shortfall, you need to pay in that cases. So this is the concept will become into picture. MTM, that is mark to market margin, is additional margin. It is additional margin payable by the parties to future contracts, that is buyer or seller, to the stock exchange if the margin paid already is not sufficient. When the margin already paid na, that margin is not sufficient, then you need to pay additional margin payable. That will be concept will be MTM margin. And what is the daily settlement in future contract? So future contract daily settlement means gain or loss on future contracts is settled by exchange on a daily basis through the contract is valid for a month or more time. So here daily settlement means the gain or loss on future contract is settled by exchange on daily basis through the contract is valid for month or more time. So for example, if you are purchased from Reliance company's stocks, and features will be Reliance stock, Reliance company features, the price will be features at 2500 today you have purchased, and the stock price went 2600 and end of the day. So you have purchased the feature at 2500, and at the end, at the market end date, end time will be 3:30, will be at that point of time the price will become 2600. So if you have entered with 2500, now it will be 2600. The price went up, and you have made a notional unrealized gain. Here will be 100 rupees per share. So stock exchange will pay the amount to you as a profit. If lot size is 100, the 100 lot size is 10, 100 into 10, it will be the 1000 will be need to pay by the stock exchange to you, because you have got the notional gain here. So you have purchased at morning over 3 months of futures, and the end of the day you have got the gain. That gain will be known as notional gain, and the stock exchange you need to pay to you, and this amount will collect from the loss making party, the seller in this case, and pay to buyer or party making profits. So assuming the stock price contract his price they purchase at different prices, and for the future settlements whatever the loss traded prices and gain or loss we will see, and what is the lot size will be there at the end, what is the total gain will be calculated. So if there is so gain or loss by end of the contract terms is similar to forward contract, that is different between the contract or agreed price versus or spot price or settlement prices. So what will be there here, the whatever the amount different amount will be there different between the contract or agreed prices versus spot price or settlement prices. So purchase price or contract price or sale price, the different will be there, it will become the gain or loss to the companies, and this stock exchange will collect or will pay to the person whoever getting that loss or who are getting the profit. For example, at the end, and today you have entered in cases, and the spot price will be there in the cash market. So market price in cash market. So what will be the future price will be there. So here the derivative prices like futures will be provided, and only in the derivative contract. So the derivative contract will be derive the value from the underlying assets. So whenever you are entering, you need to check which is the derivative when the underlying assets. So based on that underlying asset, the price will be changed. For example, one company is there, Indian HDFC Finance Company, he is trading, he is now trading at 118 rupees, and you are expecting that price will be fall 100 rupees. So it is trading 118, and you expecting fall with 500 rupees by 28th February, and you have decided to use future contract to get the benefit from that price drop or decrease. So now you can go with the contract, future contract, and underlying assets will be HEFC securities, and we will go with the what is the view will be there, that is bearish market, and that is negative will be there, and the current market price is 118 and target price will be 100%. So what is the action we can do here? We will sell the future contract today at higher prices, buy later at 100 rupees, so different will be the gain. So contract, so at the April contract expiring on maybe on that day, price of the day, and we will see the lot size and contract value we will see, and margin amount we will get the what is the margin amount on that contract value into margin percentage will be multiplied, and that amount will be called as margin amount. If you are sell today, your investment will be what is the price, and future price is what is there, and contract will be there. For example, if your sale price is 118, your buy price is 100 rupees, and you will gain will be 18 rupees, and if you have your lot size will be 400, so 18 into 400 72,000 I think gain from the contract, and investment whatever the investment you have put, that different amount it will be the gain, and that gain we will convert into the percentage gain divided by whatever the total investment into 100, it will become the returns percentage. And what is the main difference in futures compared to forwards is standardization future or standard contracts. So what are the standard features? So there are different standard features will be there for future contracts, then forward contracts. What are the features? So since many people use these contracts in the market, all terms and conditions of futures are decided by stock exchanges, so all parties know how these contracts can be used. The standard terms are lot size, margin percentage, or expiry date, or number of contract, or settlement price, or availability of stocks or assets in the derivatives segment, or eligibility criteria to keep some assets in derivative segment. So here lot size means there will be large size. So company will get this large size. Large size means minimum quantity. That is minimum quantity any person can buy or sell as part of that contract. So this is decided by exchange like National Stock Exchange (NSE). If the price is low, they keep that last size as more, and lot size is less if the price will be more. Based on the market price, they will decide this lot size. When the market price is low, they will kept this lot size more. When the market price is high, they will keep this lot size will be low. So if you want to trade, use any this contract, you can buy one and more contracts, which means you may not find a contract for exact quantity you want to buy or sell future. So for example, if you have a companies, Airtel companies stocks, 15 stocks is there, and you want to sell future contracts for 15 shares, and if it is not possible, you take one contract, you are selling 1010 shares. So if you have 15 and you are selling 10 shares, if you sell two contracts, quantity will be 20. So for the futures, it does not require the shares will be existing on that date. So the this lot size can be changed anytime, and generally this exchange changes when the price is changing due to corporate action. So by company, when the company is taking any corporate action, the share price will be changing. But for changing that price, the lot size will also be changed over a period of time. Price will be increased. So example, Nifty 50 contract lot size will be there. Now here itself what is there, and after that margin percentage. So anyone using derivative contracts need to invest or pay margin in advance to stockbrokers to ensure that party will not default to settle the contract. So margin means it is some amount. So whoever using this derivative contracts and contact need to invest or need to pay margin in advance to the stockbroker to ensure that party will not default to settle the contract. In case of futures, buyers, sellers both need to pay margin as percentage on contract value like 20%. In options, so option seller need to deposit the money since that party has maximum loss possibility. Buyer of option pay premium only that maximum loss possible to him, so margin is not required. So here the case will be, so generally this margin will be fixed around 20% by the stock exchange on the contract value. So since these stock are expected to increase or decrease, maximum will be 20%. The circuit breaker or circuit filler will be changed based on the volatility. They may change this initial margin in 5%, 20%, 25%, 30%, whatever will be there. Now it will maximum will be 20% will be existed, and this margin percentage increase for volatility stock. So exchange is not in trouble if the margin is less and less is more for the buyer. Example, when Reliance companies is increasing or decreasing more in the recent times, exchange kept higher margins based on that this contract. What is mean by expiry date? Expiry date means in India, future contract and stock options contracts expiry on the last date. So expiry on the last Thursday of each month. In index options like Nifty 50, Bank Nifty, expiry date are each Thursday itself. So here for the stock option, contracts will expire on last Thursday of each month on last Thursday. Whereas if you go for Nifty 50 or Bank Nifty, expiry date are each Thursday. Every Thursday there will be the expiry date for this Bank Nifty or Nifty Bank or Nifty 50. Whereas stocks and future contracts options, the expiry rate date will be the last Thursday of each month. An international market like US, last Friday is considered as expiry date for the derivative contracts like futures will be there. And after that, what will be this settlement process? Settlement process will means you have two bases. The derivative contract can be settled on basis of cash basis or on basis of physical settlement. So cash settlement will be there and physical settlement will be there. For cash settlement means the loss making party will pay the cash to the profit making party, and there is no physical delivery has stock, commodity or any other underlying asset. So for the cash settlement means the loss making party will pay the cash to profit making party, and there is no physical delivery on the stocks or commodities or any other underlying assets. And example, we have sold forwards or future contracts at some amount per share of company. For example, retail company you have sold for 2500 rupees. If you are delivery all that stocks and takes 2500 on settlement day, so it is a physical delivery. If it is a physical delivery, if the market price is went 2700 on that day, you need to pay 200 rupees loss since you have sold for less price than market price due to that contract. If in case in cash settlement, you will pay that 200 rupees to opposite party, and the party can use originally 2500 to be paid you if you deliver the stock plus 200 that is paid to by you to buy the stock price. So settlement price will be there 200 rupees. So we will see that it is physical settlement or cash settlement. Cash settlement will mean that you will pay the net amount, and where they have the physical settlement will be there, the physical assets will be delivered, the shares will be delivered plus the last amount will be payable. In cases in physical settlement, you actually deliver the stock underlying and take the agreed money like 2500 per share, and generally forward contracts follow the physical settlement, and whereas future or exchange traded contracts will follow the cash settlement. However, in the recent years, both most of the stock exchange went for physical settlement to avoid the excess speculation in derivative. So in this case, if the investors paid the 20% margin at the time of entering into contract, they have to pay remaining 80% is there not, and at the time of taking delivery they take gradually like 20% on each day. Means every third day it will be settled for that third day. They will collect Monday 20%, Tuesday 20%, Wednesday 20%, and Thursday 20%. Already they will collect the 20% at the initial starting only. So total 100% will be collected. And if contract is if expiring on Thursday, they take extra 20% per day on their cases. And eligibility criteria for stock to include or exclude in the derivative segment. If a stock is listed in exchange after IPO, investor can buy or sell that in regular intervals. So the stock can be available in derivative segments like futures and options only after sometimes if these stocks meet the eligibility criteria set by the exchanges. So stock is listed in exchange when after the IPO, investor can buy or sell in the regular intervals. These stocks can be available in derivative segment like futures and options only after sometimes if these stocks meet the eligibility criteria set by the exchanges, and only big companies like top 500 companies based on the market cap are eligible to consider for this purpose. Exchanges also check the daily trading volume and volatility in the stock, etc., to decide if the stock can be included in the derivative segment or not. So approximately they have, I think, 200 to 250 companies are available in the derivative segment. Out of 6,000 companies are listed in the stock exchanged. So eligibility criteria will be, so everyone who have after the listing and the exchange criteria set by the exchange, that stock exchange kept some criteria who have meet that criteria, they will allow for this futures derivative segment allowability for trading. So means that only big companies like top 500 companies based on that market capitalization, they are eligible for this purpose of exchange. Also check on daily trading volumes and volatility will be considered for the is criteria. And there the and options of that commodities, though if the commodities and volatility is good available in derivative segments, commodities exchanges introduce contact commodities like gold, silver, steel, crude oil, etc. And currency related derivatives like futures and options on USD or GBP, etc. are available in the stock exchange like NSE will be allowed when the market capitalization based on the volatility of the company. And this will be case in derivative concept. In next video we will continue the concepts.